Good afternoon. This is David with Everything Economics, and today we're going to talk about a little bit about investing. We're going to talk about dollar cost averaging. This is a very user-friendly investing strategy, and it's perfect for beginners or anybody with limited budgets. A lot of people practice it. It's very easy to do, and I'm going to go into some of the details and show you a few examples of how it works. All right, so let's get started. So why does it matter for beginners? Well, one, it's you start investing with small amounts, and particularly when you've got high inflation right now, and grocery prices are high, and gas prices are high. Obviously, you may not have a lot of money to invest in stocks or ETFs or mutual funds. So you can start out with very small amounts, and you can build long-term wealth early on, or if you're just getting started, you can whether you're in college or whether you're fresh out of college or just starting your career, or even when you're older, you can start building wealth. There's no need to predict the market, so you do not need to be watching the news every day and finding out what the market might be doing or what interest rates are going to be doing. You just invest on a regular basis, and over time, you will accumulate more wealth. And it works well with part-time income. So say you don't have a full-time job, or maybe you got a side hustle and you just want to put a little bit aside for investing, so you can do that. It's very easy to do. So let's continue. How it works? Well, you invest a fixed amount regularly. So you could be any amount that you want. It could be $20, it could be $25 a month, it could be $50 a month, $100 a month, whatever it is that you can spare. Um, and then over time, as you contribute a little bit of money each month, when you can buy more shares when the price drops, because the price is always fluctuating on the stocks or on the ETFs. So you can buy more shares when the price is low. Uh, when the price rises, of course, you buy fewer shares because you don't have as much, because it's more expensive to buy. But over time, the average cost evens out. So over time, you buy some shares when they're low, you buy some shares when they're high, and it averages out over time, and you'll slowly be accumulating wealth. So here's a real life example with a limited budget. So say you have only $40 per month to invest, and you can only spare that amount of money. So on month one, you decide to buy a stock, and the price of that stock is $10, and you can only buy 4 shares. So you buy 4 shares at $10. Month two, you can buy, the price has dropped, so the price has gone to $5, and so you can buy 8 shares. So you can buy twice as many shares. And month three, there's a boom in the market, and the price is now up to $20 per share. And because it's more expensive, you can only buy 2 shares. So your total amount of shares in this 3-month period is 14 shares. So you spent $40 a month for 3 months. You bought some shares. You bought a total of 14 shares. So you've invested, let's see, you've invested $120. And that would be 3 months times $40 per month. Now, at the end of month three, we have acquired 14 shares. So let's see how much our net worth is on here. So we have 14 shares, and the latest price that we saw was $20. So we have $20. And so that's going to be a total of, let me get the calculator out because I'm not brilliant. So that's 14 shares times $20, and we have a total of 280. So you have put in $120, but at the end of 3 months, the value of the shares have gone up, and so you have $280 worth of shares, which you could either hold on to or you can sell. But either way, it has averaged out all over time, despite what the price of the market is. So we went from $10 to $5 to $20. It does not matter about the fluctuation of the market. You kept buying $40 per month, and over time, it has accumulated. So let me just illustrate this in a graph here. So we have here a graph. We have here months, and I'm going to mark them here. We have month 1, month 2, and we have month 3. And then on the y-axis, I'm going to put number of shares. And my pen is kind of slow today. So let's see what happened. We on the first month we were able to buy 4 shares because it was at $10 a piece. And the second month we were able to buy 8 shares because it had literally doubled. So 8 shares, I mean, I'm not saying it doubled, but the price had dropped by half. So it was $5 a share. So we could buy 8 shares. And then on the third month, the price really took off on the price, and we can only afford to get 2 shares. And so let's see, it's actually going to be 12, and that's going to be 14. So our total number of shares is going to be 4 is what we started out in the first month, and then cumulatively, the second month we have now a total of 12 shares, and then the third month is a total of 14 shares. So, you know, our investment has gone up, and I imagine if we did a fourth month, fifth month, and so on, then we'll really start accumulating some wealth here. And this is regardless of what the stock market is doing. So you just keep on buying on an average basis each month. All right, let's continue. What are the key benefits of this? Well, one, it reduces stress and guessing. Nobody likes to guess on the stock market. It can be quite risky, and you know everybody's afraid. Well, when's the right time to get in, or when is the right time to get out? You don't even think about that. You just keep buying, regardless of the prices. Now, keep in mind, it's best to buy maybe an ETF or a mutual fund or a reliable company. An ETF, mutual fund, or rely good company, strong company. And a strong company could be one that's very popular. So, example, Microsoft. Microsoft is a good strong company. Nvidia, you know, something that is solid, stable. Uh, who knows? Goldman Sachs, investment company. If you invest in some small fly-by-night company that you really don't understand, then it's probably not quite a good idea. Although you could still do it, but your risk is going to be increased. The second thing that happens is that you encourage consistency. So you're continuing to do this every month. So it's not like, I mean, yes, you could stop at some point. You know, for example, if you needed the money due to, let's say, inflation, you needed the money and you need to put it on hold for a few months, you could always do that. But otherwise, it's kind of like a habit, you building up consistency. One, it helps you build financial discipline, especially early. So, you know, the earlier you do this, like when you're young, when you're in college or fresh out of college, it helps you build financial discipline, it helps you keep attuned with the market, and of course, building up some financial reserves. And then you can take advantage of the market dips. The market is always fluctuating. Doesn't matter. It's always fluctuating, and you can buy 1 month here, the next month here, the next month there, and so on, and you're always taking advantages of those dips that are occurring. So it's a very good strategy, very simple, very easy to use. Like I said, stick with an ETF or stick with a reputable company that you know that's sound and steady, and you can watch your money take off. So things to watch out for. One, it requires consistency. So, you can't just buy 1 month and then 2 months and then quit. You do have to keep doing this consistently over time. The market may go up overall, so a lump sum could win. So in other words, your stock that you might be investing in may continue to go up and get more and more expensive. That's okay, because the average is just going to be higher and higher. Watch out for fees on small investments. So, whatever you do this through, whether it's through like a company like E-Trade or some other online investing like Scottrade or Capital One, watch out for those fees, because they can add up if you consistently buy on a regular basis. Uh, Most of the time, though, like for example, E-Trade, I don't even think has any fees, or if the fee is there, it's very small. So that's not something you have to worry about too much. Let's see. So let's do a practice question. Let's say you invest $100 per month. Okay, sounds good. The prices per month. The first month is $10. Second month is $20, and the third month is $25. Well, how many total shares do you own? So think about it. The first month, you invest $100. So $100 the first month, and the price is at $10, so you can buy 10 shares. I'm just going to abbreviate SH for shares. Second month, you put in another $100, but now the price has gone up to 20. So now you can only buy 5 shares, because 100 divided by 20 equals 5. And then the fourth month, the price keeps going up. Okay, we're in a good market here. But now you can only buy how much? That would be 4 shares, because 4 times $25 equals $100. So in this 3-month period, you have purchased 19 shares total. And the price, as you can tell, keeps going up. And the higher it goes, the less shares you can buy. But hey, you're actually making money here. So the answer, of course, you have 10 shares the first month. You add 5 more shares the second month. The third month, you add 4 more shares, and now you have a total of 19 shares. So here's a bonus question. What is the total value? Well, if you remember from the previous screen, the first month was only $10. The second month was $20. And the third month, which is right now, would be $25. So the total value is 19 shares times the current price, which is $25. So let's do that in the calculator. 19 times 25, you have $475. Now, how much did you invest? Well, if you recall, we only invested 100 per month. So you invested a total of 300. $100 each month. But after the third month, because the stock market is going up, you have a total of $475. So that is the basics of dollar cost averaging. It's very fun, very easy to use, and you can make money that way. And you can, especially if you're new to the market, this is a great strategy to start out with. All right, well, stay tuned for more videos coming up soon. This is David at Everything Economics. Bye-bye.